Wall Street just got a brutal reminder that geopolitics can override every earnings, beat every rate cut, hope, and every bullish chart pattern in a single trading session. If you have been watching your portfolio bounce around over the last 2 weeks, without really understanding why, this video is going to connect every single dot for you. Stick around, because the picture forming right now involves oil at $94 a barrel, a shooting war between the United States and Iran that refuses to cool down, and two of the most important technology companies on the planet getting absolutely hammered on the very same day. By the end of this, we are going to walk through exactly which sectors are getting crushed, which ones are quietly benefiting, and what professional traders are watching heading into the next Federal Reserve meeting. Let us start with the headline that really set the tone for July. On July 22nd, Brent crude jumped roughly 3.4% and closed above $94 a barrel, briefly touching almost $95 intraday. West Texas Intermediate climbed about 3% to settle near $87. Oil at these levels ripples through airlines, consumer spending, and inflation expectations. The driver behind this spike was the ongoing military exchange between the United States and Iran, with American forces reportedly completing 11 consecutive days of strikes. Every time headlines suggested a possible diplomatic opening, stocks would bounce, and every time tensions escalated, sell orders returned. We have been trading a headline-driven market for weeks, and that uncertainty premium is why volatility is elevated across major indices. On July 23rd, when oil pushed further into triple-digit territory relative to sentiment, the Dow Jones Industrial Average dropped about 500 points in a single session. That decline coincided with a wave of mega-cap technology earnings, and normally, you would expect strong revenue growth from the biggest companies to be celebrated, but that is not what happened. Alphabet reported second-quarter revenue of about $119.8 billion, comfortably ahead of expectations. Cloud revenue grew more than 80% year-over-year. Net profit tripled, and the Gemini app crossed 950 million monthly active users. Yet the stock still fell more than 7%, because Alphabet's spending on data centers and artificial intelligence infrastructure surged dramatically, and adjusted earnings per share came in slightly below expectations. Wall Street has decided that beating revenue estimates is no longer enough. Investors now want a clear line of sight to profitability. From all of this AI spending, Tesla told an even more dramatic version of the same story. Revenue grew year over year, but adjusted earnings per share landed well below expectations, and the stock fell more than 14% in a single session, one of its steepest percentage declines in years. Investors questioned whether the company's pivot away from pure electric vehicles toward robotaxis, the cybercab, the Optimus humanoid robot, and energy storage products like Megapack is translating into near-term profit. With Tesla trading at a very rich price-to-earnings multiple, the stock has very little room for disappointment. When you put Alphabet and Tesla together, the combined loss in market value ran into the hundreds of billions in a single day, showing how sensitive this market has become to the AI capital expenditure narrative. This is not isolated to just two stocks. Oracle has been under pressure as investors scrutinize negative free cash flow. After enormous data center spending, Salesforce got downgraded by a major investment bank and is down substantially for the year as enterprise. Software names face repricing. Meta Platforms slipped ahead of its own earnings report, as traders braced for similar reactions if capital expenditure commentary disappoints. What we are watching is a rotation in how the market values the Magnificent Seven. For the last 2 years, the story was simple. Spend aggressively on AI infrastructure, and the market rewards you with a higher multiple. Now, investors demand proof that this spending turns into free cash flow. That sets up an important stretch of earnings ahead, with ARM Holdings and Meta Platforms scheduled to report on July 29th and Amazon following on July 30th. Amazon has committed roughly $200 billion in AI capital expenditure for the full year, so its report could trigger sharp swings, depending on how management frames the payoff timeline. Meanwhile, a clear rotation is happening beneath the surface. While chip stocks struggle, the semiconductor ETF, known by the ticker SMH, posted its third weekly decline in 4 weeks, pressured partly by news that a Chinese AI startup called Moonshot AI unveiled a new model narrowing the performance gap with leading American systems. Capital is rotating out of hardware and into software and services. With more predictable margins, a trend traders call the sell chips buy software trade. On the other side, energy stocks have been a bright spot as oil prices spike, while fuel-sensitive sectors like airlines face opposite pressure, since jet fuel compresses margins. Retail has been a quiet outperformer this month, led by names like Group 1 Automotive and CarMax. Watching the headline index number alone tells you very little about these underlying currents. Zooming out to the macro picture, all of this volatility is unfolding. Just days before the Federal Reserve's Federal Open, market committee meetings scheduled for July 28th and 29th with the rate decision due out on the 29th. The Fed has held its benchmark rate steady in a range of 3.50 to 3.75% for 4 consecutive meetings. But internal debate among policymakers is real. Some officials believe inflation risk has cooled enough to allow rate cuts, while at least one sitting Fed governor suggested the risk balance has completely flipped toward inflation containment. Futures markets are assigning a 24 to 25% probability that the Fed could actually raise rates rather than cut them. This meeting happens against a backdrop of oil prices spiking toward the mid-90s due to an active military conflict, a combination that is genuinely tricky for central bankers, since a supply-driven oil shock pushes inflation higher without reflecting an overheating economy. The Fed has very limited tools to offset a geopolitical energy shock without risking growth, and traders will listen closely to the policy statement and Chair's press conference for clues. Here is how to frame the next few weeks for your portfolio. First, keep a close eye on crude oil prices because, as long as the Iran conflict remains unresolved, oil is the biggest swing factor for sentiment. Second, pay close attention to capital expenditure. Commentary from the remaining Magnificent Seven earnings reports, as ARM, Meta, and Amazon will either reinforce or calm AI spending skepticism. Third, watch the Fed meeting closely for the tone and language used around inflation risk, which will set expectations for upcoming autumn meetings. Fourth, do not ignore the sector rotation happening beneath the index level because chips, software, energy, airlines, and retail are telling very different stories. This is a market pulled in multiple directions at once by war, an earnings season punishing spending without proof of returns, and a central bank navigating a supply shock. Staying informed on the details matters more right now than it has in quite a while. Make sure you are subscribed as we track these threads and drop a comment, letting me know which story you are watching most closely.